Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to James Sim of River and Mercantile, one of the finest investors in European equities. So welcome, James.
Thanks, Paul. Thanks for that intro.
Yeah,
Lots of,
well,
no pressure.
no pressure. Yeah, well, your fund's done pretty well over the last, since inception, certainly over the last 3 years, beating the benchmark indices. So I'll give you a pat on the back, that's for sure. Now, just macro, we've got luckily we've got inflation cooling across the world, the UK, Europe, and the States, and their central banks seem to be on hold for next year. So putting all that together, what's your sort of outlook for European stocks for 2024?
Look, I'm broadly constructive, really, and there's a few reasons for that. The big one really is that the cost of living crisis is basically over now. So we've had a period of 12, 18 months where wages have been squeezed. Excuse me. Oh, sorry, Paul.
Yeah, it's okay. You're right. Wages definitely have been
Oh,
squeezed. Hope you get some cough mixture there as well.
Anyway, so no, look, over the last 12 to 18 months, you've had a big squeeze, haven't you, on wages? And that's broadly coming to an end. There's a simple reason for that, which is that the wage settlements we've seen have been sort of 4 or 5% a year in terms of growth. And obviously inflation's been running, up to 10 over the last few months. And that's coming down very quickly. And so for the next 12 months, you've got those wage settlements feeding through. So you're still going to have reasonable wage growth, but you're going to have much lower inflation. So the consumer can start spending again. And the really exciting thing as an investor is you're starting with very low valuations. I mean, I'm sure your viewers will know that Europe is probably as cheap as it's ever been, certainly relative, a bit like the UK in many ways. And then you've got this small group of stocks in the US that are very expensive. So the opportunities as a sort of active manager are very high. And because you're coming off low valuation, you've got inflation coming down, you've got interest rates probably under control from here, probably Fed's done its last rate hike. And then you've got this earnings growth story coming through now from the consumer side, and also from as industrial businesses start to reinvest again as the recessionary fears fade. You're in quite a good place, really. So my outlook would be pretty constructive, I would say.
Yeah, and I guess then in that case, your European fund must be pretty sort of like offensively positioned. Then I guess you're looking for sort of like a good performance. So you're not going to be hiding out in sort of real defensives. You're going to how have you positioned it?
It's interesting because over the sort of 15 years I've been doing European equities, there's tended over that, because we've lurched really from one crisis to another, there's become this real fetish for these sorts of very defensive growth businesses in Europe. And of course, a lot of them are great businesses and we own some. But I think what it means is that you end up with this like overlooked cohort of the market. And as you say, we tend to try and move a bit with the cycle. So if we think growth, it's a good environment for growth stocks, we'll buy some growth. If we think it's time to be a bit more defensive, we'll be more defensive. So we do move it around a bit. And at the moment, as you say, I am actually, given I'm reasonably constructive on the business cycle, we've tried to kind of expose the fund to some of those more cyclical areas that are very cheap, that are going to see really good earnings growth. And that's what we've really focused on.
Yeah. And is there any sort of like, major differences between investing in Europe compared to the UK? I mean, obviously we're outside now because unfortunately, because of Brexit. But how, just for something, for investors to be aware of the differences?
Yeah, I mean, look, basically, if you're a good investor, the same principles apply. You want to have a bit of valuation discipline. You want to be looking for good businesses, perhaps they're a bit out of favor. I mean, I tend to be quite contrarian. So I think the sort of broad principles are the same, but there are some nuances. I think one thing that people think of, and it's sort of in your question, is the way you think of Europe as one block.
Yes.
Think, well, that's what. How's it different Europe to the UK? But actually, very different environment in Switzerland, say, than Spain, or even Germany and Italy. And then even within Italy, you have these companies across the north of Italy, around Milan and Trieste and in Lombardy, that are incredibly kind of almost Swiss in their mindset. Very long-term view, reinvest in a lot of R&D, very innovative. Maybe global leaders in their little niche. And that's very different from say, southern Italy, or some of the more kind of, let's say, almost like state-owned enterprises sometimes you get in Europe. I mean, you do get more government interference. You get more family businesses, where the family or the founder will still have a big stake and control. We don't, I think only my former shop at Schroders is probably one of the very few, probably the only left FTSE 100 company with a big family ownership. Whereas that's quite commonplace in Europe. So I think there are nuances, and you just need to be aware. It's more of a stakeholder capitalism in many ways, and you want to be obviously, you're trying to get on the right side of that.
Yeah, well, one stock you've done absolutely brilliantly on over the last. I wish I owned it in sort of healthcare, because it's one of my favourite places. Is Novo Nordisk, which is, investors may want sort of be familiar with it, but it is one of the leading GLP-1 drugs, which is Wegovy, I think, for diabetes and for weight loss. You want to take us through this one, because it's just been a rocket ship.
It's kind of our Europe's answer to the some of the Magnificent Seven in the US, isn't it? In the way it's behaved, yeah. So I've owned Novo for quite a few years. We bought it at launch. It's sort of been our go-to pharma stock for a number of years. And the reason for that is as follows. They've got a very dominant position in diabetes. Them and Eli Lilly and Sanofi, between the three of them, they sort of split up the market, and Novo is probably the most innovative of the three in terms of being able to develop new drugs. And that's just meant that the treatment of diabetes has got that bit better every year. It's not really been big bangs. Sometimes you see these pharma companies that come out with a killer product. It's more been constant improvement. And I think probably about 5 or 6 years ago, and I meet them regularly, and 5 or 6 years ago, they started to talk much more broadly around this new class of drugs, as you say, called GLP-1s, and their ability to control weight loss, to control weight. And if you think about diabetes, really it's a spectrum. The treatment of diabetes, it starts with making sure people lose a bit of weight at the very beginning, and then it ends up, you're on basal insulin and all the various other treatments. So there's a whole spectrum, and Novo's been brilliant over the years at moving earlier and earlier in that treatment phase. And now what they're saying is we can treat obesity. And obviously what that's done is come through the diabetes franchise, but what it's meant is that obviously there's huge addressable market there. I mean, I think there's something scary stat, something like 40% of the US are obese, and it's probably 30% in the UK.
I've heard $100 billion market at the peak sales.
But so this is where it gets interesting. Now, what's happened is that the market has increasingly said, well, every time Novo's come out with a new sort of indication on this GLP-1, Wegovy and Ozempic, so the semaglutide family of drugs, then each indication adds to that, as you say, addressable market. And I suppose it's just the way the market's working at the moment is you've now priced a heck of a lot of that in. So yeah. I've actually been, having done very well out of it, I've been selling some of my Novo more recently.
That was strange, actually.
Discipline, that's where that comes in.
Yeah, because I was going to ask you, when do you top slice? And sort of a broad rule. So, for other shares, if it does really well, is there a position you decide then to take a bit of profit off the table?
Really, because it's got to be case-by-case basis, hasn't it? I mean, I tend to be slightly more valuation-oriented than most investors, although I wouldn't class myself as an out-and-out value investor per se. I think I'm more of a contrarian investor, really. I don't think I can claim Novo's contrarian today, so that's one data point.
It was when you first bought it.
Well, it wasn't so loved, let's put it like that. Basically what's happening in the whole medical space is that these two companies that have developed GLP-1s, which is Novo Nordisk and Eli Lilly, have just sucked in all the market capitalization from all those other companies. Because if you think about it, obesity is everything. I mean, it has an effect on diabetes, but it also huge impact on cardiovascular disease. It impacts your risk of cancer. So all the oncology franchises, we're saying they're less valuable than they were. There's a UK stock called Smith & Nephew, which does knee implants. And people have said, well, if people aren't so obese, they won't need as many new knees. And then obviously Smith and Nephew say, no, it means that more people need new knees because now we can treat them. Whereas if you're too fat, you can't be operated on. Yeah. So there's all this debate going on. But basically what's happening is the markets, it's kind of a classic hype cycle, Paul. What's really interesting now is, though, every time Novo come up with some new piece of good news, the shares aren't really going up. And I think that's when you can start to peer through the gloom and say, we're probably pricing in a pretty good story here. Yeah. And if I look at it, if it's 7% of the US population on these drugs, it's a sell. Yeah, okay. If it's 30 or 40%, it's still a buy. Yeah. And it's $1,300 a month to go onto these drugs, and obviously that will come down over time. But this is expensive. You know, not every person in the world is going to be taking GLP-1s of that, I'm pretty sure. Yeah. Certainly not until they go off patent. So I think by which point obviously Novo doesn't make any money. So I think that's where we're getting to now, is quite hard to see where the upside is from here given the valuations. Yeah.
Well, you raise a really good point there, because it does seem to have sucked the air out of all the other healthcare stocks. And I mean, the next one
beyond that, Paul, because even McDonald's sold off the other day because the idea that people weren't going to eat as many McDonald's because GLP-1 suppresses your appetite. So it's
yeah, not from me. I'm going for a Big Mac tonight and fries.
Yeah, right. Okay.
But now moving to Roche, which has been sold off. I don't think it's related to it at all, but it's one of obviously the world's biggest, based out in biopharma companies. Has a big oncology franchise. Also has diagnostics as well, and it's trading at around about 12.5 times PE. I know it needs to sort of refill its pipeline, but what's your sort of latest on this? Because it does look pretty cheap for a high quality company.
Yeah, no, look, well, there's two big Swiss pharma companies, of course, Roche and Novartis, and you know, having done this job for a few years now, they kind of swap play. It's a bit of a merry-go-round. You know, one moment one will be in favour because they've had a few. It's almost behavioural finance, Paul. When they've had a few good results from the pipeline, everyone says, "Oh, they've got a brilliant R&D platform." And then when they get a big rating, and then when they've had 2 or 3 disappointments, everyone says, "Oh, they've men in white coats running that company. They were flushing money down the toilet," and they get a much lower rating. And what's happened to Roche? I think there's 3 things that have happened that mean it's on this kind of all-time low valuation, really. And I think all 3 of those probably go away. So the first one is they were a big beneficiary of COVID. You know, you mentioned their diagnostics franchise, and obviously a lot of their COVID-related testing was done by Roche. So that was a big one-off boost, and we've had the unwind of that. So that's hit them. They have had a few drugs that haven't come through. They've got 100 years worth of heritage in developing new drugs. Oncology is a growth area broadly over time. You know, there's a lot of people in the emerging world that don't treat cancers sadly to as full as they could be. And Roche have got a very good long-term track record of developing drugs over time. And yes, it's never a straight line, but I think as an investor, you know, if what clients are paying us for, isn't it, is to try and peer through that short-term noise and take a slightly longer-term view. So that's the second thing, which I think, you know, will swing the other way. And they've got quite a full pipeline next year and the year after in terms of readout. So any of those could be a good catalyst. And then the third thing is, you say it hasn't affected them, but I think it actually has weighed on the franchise, this GLP-1 wonder drug, Novo Nordisk effect. I think that has, you know, caused a derating of the shares. And, you know, as we know, healthcare budgets are healthcare budgets. They never go down. There's more old people in the world. Yeah. It'd be great if there was less obesity, but we're talking about these drugs are going to be used on very obese people to get them to lose 15% of their weight. You know, there's still going to be a lot of cancer in that slightly overweight and even not overweight people, you know, as well. So I don't think it's going to have a material effect on the size of their overall market. And therefore that kind of derating looks a bit overdone. So basically, I always like it when you can identify the catalyst, you see why something's happened, and then you sort of form a strong view that either that's very valid and you don't buy the shares, or you say, well, actually, there is a story here. And I think that's the case with Roche.
Yeah, it does seem to be a beneficiary of long-term secular growth, you know, certainly. And I'm with you. GPL1s seem to have impacted everything outside of obesity in terms of sucking the valuation down. And so if you get a technical sell-off on shares, then it means that there's more upside, no doubt about it. Now, another one you've got in the portfolio is Sanofi, and that again is trading at, around about 12 times PE and on sort of trough earnings. What's your sort of your latest on this? Because it does sort of like, again, speciality, sort of like, biopharma, sort of rare diseases in cancer. And I think, as you say, it's also got that, sort of diabetes
franchise as well, Yeah. Look, Sanofi was the kind of, is the one that's been left behind from an R&D perspective within diabetes.
Yeah.
It's not it's French, it's not Swiss.
Yeah.
It's not perhaps as productive. I mean, if you've ever visited the Sanofi headquarters, it's very if you go to the gents' toilets, it's all, I'm not quite sure if it's real gold plated taps, but they are very fancy looking. So there's a cost cutting story there, that's for sure.
Yeah, okay.
But yeah, that's more of a valuation story. Sanofi is a smaller position for me. And that's kind of, one of the defensive areas that we're exposed to, but actually most of the portfolio is in more sort of front-footed cyclical areas to make benefit of that pickup that we're expecting.
Yeah. Okay. Well, one which is definitely front foot is AMSL, which I think is really front and center for all things AI and building out GPUs for NVIDIA out with TSMC out in Taiwan. Do you want to take us through this one? Because another one, it's just been a real sort of like horse for it. It's just kept on galloping.
Yeah, so another large cap growth stock there. Again, it's a slight underweight for me, ASML, but it's a company I owned. I think I first bought it in 2014 at about 60 euros, and I sold it 12 months later after it had gone up 60% and gave myself a pat on the back. And when we launched the new fund, I found myself buying back into it at about 600 euros. So, it just goes to show, doesn't it? Some of these long-term compounding stocks you don't want to be too cute with. I mean, ASML basically has a global monopoly as, it was Europe's biggest company not very long ago. I'm sure people know it, but it has a global monopoly in extreme ultraviolet lithography, the very high-end lithography machines. It took them 20 years of R&D, I don't know, 30, 40 billion of research and development to develop that technology. If China ever invades Taiwan, the first thing you want to do is go and buy ASML, because ASML basically will then have to provide its cutting edge machines to all the other places outside TSMC, which will probably be Intel. But it's a key provider for keeping Moore's law going. AI is the next iteration, as you say. It's a very well-orientated business, but it's not hugely out of favor. So you buy that when it's, it halved a year ago, so we bought into it. You buy it when it had a bit of a wobble, but it's a long-term compounding, very good business with a great market position.
Yeah, you won't top slice this one like you have done Novo Nordisk at all, because you've just done so well out of it.
Yeah, there's other companies that I think are more exciting in that ecosystem, to be honest, than ASML.
Yeah,
I mean, ASML, well, for Moore's law is the concept that computing power halves every 18 months, right? And it's started in 1960. Mr. Moore, by the way, was a former CEO of IBM who just sort of came up with it as a passing comment, and it became a law. And obviously it's been at the heart of the technological advancements that we've seen over the years. We're running into something called Moore's strain. And Moore's strain is where Moore's law no longer operates.
Yeah.
And the reason for that is that we're writing chips now. The way Moore's law works in practice is you shrink the size of the chip in half, and that roughly halves the cost of the computing power roughly every 18 months. And there's been a whole industry roadmap for it. The chips are now so small that to write a circuit on a chip, that's half the size, it just gets exponentially harder. So it's not linear anymore. It's so much harder. Case in point, it's taken ASML 20 years and 25 billion to develop EUV. So the next iteration is going to be incredibly difficult. I mean, we're talking about writing circuits on chips that are at the leading edge is 3 to 5 nanometers. I mean, the chips are like 20 or 30 atoms across.
Yeah.
So you're running into all sorts of weird quantum effects.
Yeah.
So the question then becomes, obviously we're going to use a huge amount more computing power, is how do you keep Moore's law going? Because it can't just be that we write on a smaller and smaller chip. And that's really where the opportunities lie. So a stock we own in that area is a company called Besi, which actually 15 years ago was a very small cap or small mid-cap company.
This is BE Semiconductor.
BE Semiconductor, exactly.
Yeah, okay.
BE stands for back end.
Yes.
If ASML is doing the front end, the L stands for lithography. So it's making the machine to write on the chip. You then take that chip and you have to package it in something before you put it on the circuit board.
Yeah.
And the packaging, so-called packaging, the machines that make that packaging that attach the chip to the circuit board are made by BE Semiconductor. And that was a commodity business, maybe 30% gross margins, 10% EBIT margins, one of 5 or 6 players that could make these machines. And because it's become so much more technical, it's become harder and harder, and the market's consolidated. And Besi, which has out-invested all its peers, has ended up probably with a 75% market share of a technology called flip chip, which is going to be critical with the next generation technology. The one after that is something called hybrid bonding, which is not really in the.
You're going to say it's got a dominant market share in that as well, aren't you?
Well, they've invented it.
Oh, so
they've invented that market, and
wow.
they've got 100% market share. So it's basically like ASML, but obviously much less discovered, and a market cap of 8 billion versus ASML, which is tens of billions. And what's really exciting, I think, is that if you look at Besi's, its top line is about 700 million.
Yeah.
And each of these new hybrid bonding machines will cost about 5 million. So they don't have to sell loads of them. They've only got to sell 100 a year, which, 2 a week. It's not actually that many when it's only, it's a £6 million ticket, before the company can double and double and double again. And if you look at capacity of what the market might need for these machines on a 5 to 10 year view, it could be hundreds a month.
Yeah. So
I think we're picking up Besi a bit at a pretty similar moment as when I bought ASML at 60 in 2014 and sold it at 90. And so maybe the lesson learned isn't just to hold on to ASML, but it's to hold on to that one, because the market is fantastic.
Well, that does sound absolutely fascinating. Yeah. And I'd never even heard of that hybrid bonding. So, yeah, absolutely. I mean, with that Moore's law, yeah, I mean, with artificial intelligence, it's going to be driving that, the transistor size smaller and smaller to be able to do more computing without, sort of generating all of that heat which comes out of it. So, yeah.
I mean, it's interesting, isn't it? So I often find that the way to do sustainability is a good example of this. You've got your very obvious plays, NVIDIA, they make GPUs. We know at the moment we think we're going to use GPUs for AI, although there's other technologies coming which might make it a bit more difficult for NVIDIA. It's like sustainability. We all know we're going to have more wind farms. And so, Ørsted does brilliantly until one day it doesn't. It has a massive profit warning. Or the turbine manufacturers, have a strong cycle till one day they don't. But what I think as a contrarian is that you go and you say, well, that's going to happen. But what are the stocks that people haven't really thought about that actually I can pick up really cheaply, but have got some technology, or there's something going on below the bonnet that we can exploit? And that's what active management in Europe is really all about. It's not like the UK. The UK is a well-covered professional market. It's pretty efficient. And there's lots of good UK investors, and I think UK is really cheap and loads of great opportunities. But in Europe, you're still able to find these uncovered gems. Maybe they don't even speak English. Maybe English isn't, they're just not as Anglo-Saxon in the way they approach the stock market as sometimes they are in the UK. And that's what we're trying to uncover. And I think Besi is one of them.
Yeah, and if it ever decides to list on NASDAQ, it's going to go to the moon, isn't it?
Well, I think it does have a bit of a fan club over the other side.
I bet it does, yeah. I bet it does.
Yeah.
Oh, that's a great one. Okay, now just moving to industrials, we've got Air Liquide, which does industrial gases. And I think, sort of nitrogen and all this sort of stuff, but it's also moving into hydrogen. I think it's got it's got a bit of a duopoly, hasn't it, with Linde, I think, in sort of industrial gases. And I know these are fabulous long-term secular compounders, aren't they?
Yeah, there's 3 players actually in industrial gases. There was 4, and then Praxair and Air Products merged. So there's the 3 of them now. Linde, those 2, and together as Air Products and Air Liquide, French business. So it's oligopolistic, but it's actually for a lot of their customers, it's a monopoly because they build a pipe. If you're an industrial company and you need a constant supply of, I don't know, ammonia or CO2 or whatever the gas, oxygen, often the cheapest way to get it there is to build a pipe. Now, obviously, the customer knows that they're then trapped with whoever they sign the contract to build the pipe. So it's not like they can put up prices 10% a year, and they've got to think about the relationships and the ability to win new contracts. But basically, they're in an unassailable position in a lot of cases. And then, of course, they each have their own speciality. So, one might be very good at medical oxygen in Germany. Another, Linde might be fantastic at, another gas use, CO2 for greenhouses in Holland or whatever. And so they end up quite monopolistic in terms of their pricing power. And they do grow over time. And the reason why I think, as you say, a big growth area potentially for Air Liquide is hydrogen, where they're an early mover and they're taking, they're doing more. Who knows what technology it will be in each particular instance? It could be hydrogen for steel production. It might be ammonia for long-term shipping. We might use electric vehicles. We might be electric for lorries, or it might be hydrogen for lorries, depending on how that technology plays out. But what over the medium term is you're going to replace all the fossil fuels in society, with electricity and other gases that don't produce CO2, so not hydrocarbons but other gases. And basically that puts these companies on a long-term growth trajectory that you can be very, very confident they'll hit. It's not very cyclical. It's a great business. It's a compounder.
Yeah. Okay, good. Well, there's another one which is actually a bit more cyclical, is Metso, which I think does sort of like equipment to sort of construction and mining industries, etc. Do you want to take us through this one? Because it has definitely been sold off. I guess if we get a, sort of like an improvement in China or all things sort of mining and construction, then it's going to really sort of take off.
Yeah. We can use Metso as an example, but this is a key investment. I'd say it's probably the key investment opportunity in Europe today, particularly for the contrarian. And so we just take a step back for a minute and I'll explain what that is, and then
no, please do. Yeah.
So just the world emits too much carbon. We know that. And that carbon floats up into the atmosphere and causes climate change. So obviously there's a big agenda to reduce that over time. There'll be puts and takes. There'll be times when it becomes political. There'll be times when there's lots of subsidies for a particular industry. But the broad trajectory is that we need to bring down our CO2 emissions. And every company in Europe I look at pretty much has got a plan to do that. And so they're going to need to use new technologies. They're going to need to buy products that are low carbon. So if they're buying cement today, they need to buy low carbon cement tomorrow if they're a property developer. If they're using steel to make their cars, tomorrow they need to buy green steel if they're going to hit their CO net zero goals. So that's the long-term trajectory. There's a cohort of companies in Europe, and we sort of touched on this already. There's a cohort of companies in Europe that are very obvious winners out of that. There's all over the world. Tesla, obviously, is a winner of the EV transition. Clearly. Now, is it a buy, is it a sell? I don't know, but it's a winner. Wind turbine manufacturers have been winners. It's a terrible industry, but for 10 years, everyone loved them. There's a group of very hard to abate activities that contribute actually most of our CO2, certainly the hardest, outside of power generation. Okay, so outside of the gas-fired power station, outside the coal-fired power station, there's a load of activities we do globally that are responsible for a large amount of emissions that are hard to abate. Steel is 8% of global emissions. Which company because it's not going to be a Tesla. It's not going to be a growth stock. It's going to be a series of the incumbent companies in that industry. Which of those companies are going to win from the decarbonisation of steel? Some will lose. Cement is 8% of global emissions. Same question. Air travel is 2% of global emissions, but it's about 6% of what we call radiative forcing. It's 6% of warming, but 2% of emissions because of where the emissions take place up in the sky and the vapor entrails and so on and so forth. So which company is going to help air travel decarbonize? And when you find those businesses, buy them.
And Metso's one.
Buy them, because they've got the opportunity to re-rate and grow much more quickly than the market thinks. Now, mining, so come to Metso. Mining is 4% of global emissions. And we're going to need a lot more copper than we're using today if we're going to decarbonize the world. We have to electrify the world. So we need probably twice the amount of copper we're currently mining. Copper is incredibly energy intensive to mine because the ore grade is like 0.5%. So you've got to crush 2,000 tons of copper, copper ore, rock, 2,000 tons of that to get 1 ton of copper. Metso make grinding and crushing equipment. Okay, 1% of the world's power, 1% of the entire world's power flows through Metso's equipment. Now, Metso hasn't really grown, and their peers like FL Schmidt, for example, they haven't really grown for the last 10, 15 years. Because after the China super cycle to 2008, all the mining companies were very burnt about how much they'd splurged on all these expansion plans. And so they all went, they all cut their cloth, put the sackcloth on and started cutting their CapEx budgets. And CapEx basically been on a one-way trajectory for these mining companies for at least 10 years since 2012. And that is now changing because the kit that was 10 years old in 2012 is now 20 years old. And there's been a massive underinvestment. Plus, they all have a plan to decarbonize. You go look at Rio Tinto, BHP Billiton, Boliden in Sweden. All these mining companies, they all have a plan to decarbonize their activities. And the most energy intensive part of their activity is the grinding and the crushing. And so Metso's order book, I expect, and it's already started, is going through the roof like this.
And that's because their machines are so much more efficient and less energy intensive, and they help them decarbonize. Correct.
So previously, all the machines in that industry were powered by diesel generators because they're in far-flung places, and now they're all being electrified. And you'll have a local solar power. So you need to re-buy all your machinery. And modern machinery is half the emissions of old machinery. So Metso have what they call this planet positive portfolio. It's held down their margin for the last 10 years because they've had to do all the R&D and all the product launches associated with it. But now they're in an absolute sweet spot to be able to benefit from this trend. So Metso is what I call an enabler. It's an enabler of somebody else's carbon reduction emissions. And the beauty of being a contrarian investor and approaching the problem in this philosophical way, rather than just saying, I'm just going to buy a load of growth stocks that are attached to that, the beauty of it is you can do it in a really valuation disciplined way. And you're actually paying no higher multiple. And as you say, it's sold off. So even a lower multiple than history for this amazing, medium term, better growth rate and better profitability and better margin. And so there's a number of companies we've got in the portfolio that fit into that camp. I'd say it's the biggest opportunity we've got today.
Yeah, I mean, I was just looking at the valuation, 13 times PE with a solid balance sheet, with that sort of secular growth to decarbonize all that mining industry. Then, I mean, that's just absolutely enormous because it isn't just copper, it's cobalt and all that kind of stuff. And we've still got iron ore that China needs and all that kind of stuff. Yeah, so,
exactly. Yeah. It's a big opportunity.
Yeah, and another one I've never even heard of is Sensirion, which I think does sort of specialist sensors for sort of clean air and to make sure things are safe and healthy, not only for the environment but also for humans as well. I think for sort of breathing apparatus and stuff. Yeah, so
it's another sort of uncovered or hidden gem, if you like, in Europe that you can find if you go and put a bit of shoe leather in. I met them for the first time actually about 2.5 years ago in Interlaken in near Zurich, and Sensirion, the founder, former CEO, I don't know what he calls himself. Might even call himself. I don't even think he calls himself CTO. But anyway, he's still sort of wandering around in his jeans and his t-shirt.
Yeah.
And he was a bloke and did a PhD, and he invented a way with another guy to attach a gas sensor to a chip, to basically put a gas sensor on a chip. And we mentioned Moore's law already. And obviously, once you've got yourself on the silicon chip trajectory, you're halving your cost every 18 months. So Sensirion, with all it, and then it was all patented and IP protected and so on and so forth. So they've basically had this big growth trajectory because they've made it affordable since the late 90s, is when they started, to be able to do gas sensing at scale in a number of areas. And the cost of that comes down and down and down. Now, why have we bought it today? Well, there's two reasons. It's not the cheapest company. It's not like a Metso or a Danieli or some of these big industrial businesses that's got a great opportunity. It's seen as a growth stock, and it's got a relatively high rating, not ridiculous, sort of 20 odd times. What's happened to Sensirion? What they do is they hide their profit in a classic Swiss German way. So instead of making 30 cents on a chip and spending 5 of it on running the business and showing a margin of 25 or 30% at an EBITDA level, what they do is they hide all that profit in R&D.
Okay.
And this is stuff that is going to be kind of one day will make them a lot of money, but for the next 4 or 5 years plus, they're not going to. It's not going to change things. This is long-term R&D, and so we need to adjust the valuation of Sensirion for that. The other reason why I think now is a really interesting time to buy it is, as you mentioned, it's all sorts of use applications, but one of them is respiration equipment. So clearly, COVID for them was a massive supernormal impact because every ventilator that was made, every CPAP machine that was made, and some needed a Sensirion chip or technology or solution attached to it. So we know that. And then there was also this kind of slightly more fuzzy impact whereby everyone started caring about air quality through COVID. And so people would go and buy themselves an air filter machine or a sensor to tell them that there was, there was too much CO2 in their house, or the NOx particulate matter living next to the road meant that their air quality wasn't that high. So they sort of had this quite supernormal period. They're now going through giving that back. Unsurprisingly, the shares sell off when that happens, and that's when the contrarian steps in and says, this is a really exciting long-term growth story, that we can adjust the valuation for that R&D, and then from here, it's really well placed.
Yeah, and it's on a cheap. I mean, I know you said the actual valuation doesn't look that cheap, but its market cap's only 1.2 billion Swiss francs. So, it's not exactly out of the ordinary. It isn't hugely well. It isn't well followed, put it that way. But also, if it has that growth trajectory, then it'll be a snip, I guess.
Yeah. I think it's got a long runway. Or if you're going to buy a growth stock, you want one. Yeah. You want to buy it when it's out of favor, and then you want it to have a long runway of growth, many years, new products. I mean, the big growth area for these guys is that up to now, really, it's only been CO2 sensing for medical devices and a bit here and there. But obviously, if you think about methane leakage from a climate change perspective, wouldn't it be great if we could put a gas sensor near all the little nodding donkeys in the US on all these facilities? And that's where they sort of come in. There's just so many use applications, and they're basically using the excess profit that they made through COVID. This is what they're doing all the R&D on. This is where they're hiding it. Yeah. They're basically using that to basically make their addressable market 5 times bigger by going into 10 different new areas.
Yeah. Another one which is a long runway, just to apologise for in advance for the pun, is Airbus, which obviously has got the iconic A320 and has got, I think it's a Dreamliner as well, and the commercial side, which really is doing exceptionally well. It's also got the military side, huge order books, and I guess this is again the decarbonisation of all things flying. Is that basically people need airplanes more efficient to basically to operate and to decarbonise the airlines.
Yes, exactly. Yeah. I mean, I was waving I wasn't waving.
No, it's okay. I got you.
It was to get the lights back on.
Yeah.
While we're talking about Airbus, so no, I mean, look, Airbus is one of those quite, I suppose, in some ways quite rare European success stories, where a European company has been able to outcompete the US company. It's wide body aircraft is a global duopoly, right? It's between themselves and Boeing. 30, 40 years ago, it was a sort of 70-30 market share to Boeing, and now it's the other way around, if not more towards Airbus. And that's, we know why, right? Because of the 737 MAX issues, because the balance sheet of Boeing. So, if you think there's two companies in the world that can help aircraft decarbonize, Airbus is the one that's going to. So I think there's amazing sustainability credentials for Airbus because of the roadmap that they've got for the R&D they've put in place. Passenger CO2 per kilometer is halved. We've got some new Indian colleagues who've joined us, a company called Ocean Dial, and I talked to Gaurav about some of the what's going on in India at the moment. I mean, it is just staggering. Yeah,
the orders are huge, aren't they?
The level of development that country is going through. Average GDP per head in India $2,500. Which is where China was 15, 20 years ago. China's now $15,000. So the scale of development that India is about to go through is absolutely enormous. They built 50 airports in the last 5 years. You can now fly to the Himalayas for a weekend vacation, whereas previously it was a 3-day trip to get there. And that has huge implications for air travel. And this kind of goes back to my point from a sustainability perspective for a minute. I mean, I'm sure people are fed up of fund managers going on about ESG, but we're approaching it in a totally different way, which is to basically say, look, 80% of the world's population has never been on an aeroplane, right? There's no Indian politician in the world that is going to stand on a platform and get elected on the basis that actually they shouldn't be allowed to have air travel. Okay. Because in the West, we've used up all the carbon budget of the world. Of course not. And neither should they. So these countries, and there's 1 billion people in Nigeria in 10, 20 years' time. Vast majority never been on an aeroplane. So it's just enormous, the scale of development. And if we don't find out how to do these activities in a more sustainable way, whether it's mining copper or producing steel or traveling around the world by air or by car for that matter, then we've got a real problem. And so Airbus is just incredibly well placed as the most efficient. It's got the best customer proposition in terms of the return on investment that the countries can make. They've got a massive opportunity to grow very significantly over the medium term, hugely capacity constrained. They have $1 trillion of working capital that goes through their balance sheet every year. So it's not like there's going to be new entrants coming into this market, and you're able to buy that for 10 times forward earnings. I mean, it's outstanding value. And outside of these, like, very few companies that have attracted these very high valuations, outside of those, you've got amazing investment opportunities all over the place in Europe and in the UK, probably, for that matter. If you're prepared to kind of take a view and be valuation disciplined.
And also have a long-term time horizon. I mean, Airbus, that's just terrific value. Another one which is absolutely been sold off and is really sort of like a low multiple is Stellantis, which is the sort of Chrysler, Peugeot, and Alfa Romeo business, and it trades I can't but less than 4 times PE, if I'm reading it correct. I mean,
you're right.
That's like 4 years, and you got the business for free.
And then you've got your other one is Renault, which I've recently taken a position in. That's 2.5 times PE.
Why are they so cheap? Is it just that all that sort of EV? They're just overly worried about Tesla or something?
Well, so I mean, you got to handle these things with care.
Paul. Okay.
I can say that. So Renault was my biggest position in 2015. It was fantastic, and we sold it. Okay, so you've got to buy them at the right moment.
Okay.
The moment to buy them is when earnings are about to move positive and everyone's very bearish, and that's exactly the scenario you've got today in both of these, in all of these auto companies, but particularly those ones. And there's 2 reasons for that. So the first reason is the margins are high.
Yes.
Okay, the EBIT margin for Stellantis is higher than it's ever been in history.
Yeah, it's 11%, but you're right, it's abnormal for a huge OEM.
Yeah, so normally people think of OEMs making 3, 4, 5% margins.
Yeah.
So what the market's discounting there is it's saying those are totally unsustainable. Now, in Stellantis' case, I think it probably will come down a bit. I think there's a big difference though, and this is just classic capital cycle investing.
Yeah.
So when you have a very unprofitable industry for a long time, capital leaves. Yeah. People go bust, mergers happen, shareholders get pissed off, they ask for their money back or whatever. And that's exactly what's happened in the auto industry, isn't it? I mean, you just mentioned Stellantis is a merger of Peugeot, Fiat Chrysler, and Alfa Romeo, or Fiat Chrysler, really. Yeah. So that, and putting those businesses together gives them big scale, so they can make a better purchasing. But it also means there's fewer competitors. And that's really what's happening, is that every auto company historically adopted a volume strategy. It's kind of game theory. It was logical to do so, because the only way you can make money in cars is to make almost none of them, and you're called Ferrari, or you make loads and loads of them. Yeah. And if you're in the middle, you lose money. Yeah. So those are the two ways to make profit in autos. But what happened was there was too many in the middle who eventually have gone bust. So now the market's totally polarized between luxury marques like Ferrari and Porsche, which is part of the VW group, and then volume players like Stellantis and like Renault. And all of those volume players now adopt a value over volume strategy. So pricing is much better, and you can only do that in an oligopoly. You cannot do it in a fragmented market. So that's what's happening there. So that's why it's probably more sustainable than the market thinks. The second reason why they're so cheap, Paul, is because it's not so much Tesla. You know, people look at Tesla and they think, well, they're going to be a fearsome competitor, but we kind of know what they are, and actually we can compete against Tesla. What people are really worried about is the Chinese. Yeah,
Chinese EVs.
The Chinese EVs coming to Europe. So with an internal combustion engine, the Chinese had approximately 0% market share. So the market share in Europe was shared between the Europeans. With the new wave of Chinese, they have got some advantages. So they've got a massive domestic EV market already in China. So they've developed a lot of technologies. And they've also got, and this is key, preferential access to battery materials. Yeah. The battery is half the cost of an EV. Yeah. So the argument is that these guys are going to be able to kill or take massive market share from the Europeans. Now, obviously, on 2.5 times, a lot of that's in the price. And I'm not saying that we're going to be owning Renault. It's not an ASML. It's not an Air Liquide. It's not a compounder. Yeah. But they have got a really good, I think, and totally reinvigorated strategy around EVs, which means that they're going to basically be able to chop the cost of producing an EV by about 40%. Yeah. Over the next 7 years. So they're going to be able to make margin, and their plan is actually to make a 10% margin by 2031. Now, we can debate whether it's 10 or 8, but there is some credibility behind that in terms of what they've done industrially to the business. And then, of course, you've got the political aspect, which is, I think it's highly unlikely that the EU is going to allow its incumbent car companies to be totally destroyed by the Chinese auto manufacturers. And the very easy answer to that is called tariffs. Yeah. We don't like them, but in this case, it might work in our favor in these investments. So that's really the story with auto companies in Europe. Super cheap, 2 reasons, both of which probably a bit overdone.
Yeah, I would agree. There's no way the European, sort of like countries are going to allow the car industry, which employs so many people in terms of the supply chain, as well as to be decimated as the solar was, years and years ago.
Yeah, exactly. I mean, there are some ludicrous valuations out there. I would just say that because of the environment we've had with higher rates and obviously very, all flows into passives and outflows out of everywhere apart from the FANGs. But you've created some real anomalies. Yeah. And the stake that Renault have in Nissan, which is 28%, but they're in 28% in Nissan, which they're bringing down to 15%. So they're going to sell it. Yeah. Well, they're selling 28%, sorry, and they're left over 15%, so they own 40 roughly today. That stake plus the cash is almost the same as the market cap of Renault. I know it's not an amazing brand. I know it's Ferrari,
but it's big in France, isn't it?
But come on, it's 24% market share in France.
Yeah, yeah.
So, you know, it's anomalous valuations, and we're seeing that actually in quite a few areas.
I guess that's why you're so positive, for one of the reasons anyway.
Well,
Now,
it's a starting point, isn't it?
yeah, I know. Now, just moving to the consumer, you've got a couple of big sort of iconic brands. You've got Carlsberg, which is obviously the beer and the brewer, and you've got Nestle, which is, you know, coffee and Kit Kat and ice cream and all that kind of stuff. How do you see both of those playing out as the sort of like the consumer is retrenching, you know, in a harder, sort of like, you know, higher interest rate environment?
Yeah. So that's, I would say, a backward-looking comment.
Yeah.
The consumer has retrenched.
Yes.
And the consumer has been very squeezed.
Yeah.
That's had two impacts. One is obviously a bit of down trading and lower volume growth, clear. But the other thing is they haven't been able to put through the price rises they've needed to put through to recover the raw material inflation. Some companies have, some industries have.
Yeah.
You know, I've just sold it, but I owned a glass bottler that did a brilliant job of more than recovering the inflation they saw through energy prices going up. So we sold it, and you know, it all in the price and done very well. And probably the next thing is that they have to give some back. The opposite's true for a lot of these consumer staple companies.
Yeah.
And so, but we've got to think on a forward-looking basis. So they're on relatively attractive valuations relative to their history.
Yeah, I think Carlsberg's on about 14, and I think you've got Nestle on, well, it's actually on about 20, but you're right, it's probably on lower earnings.
So Nestle's always expensive because it's a great business and it's Swiss.
Yeah.
So the cost of capital is really low.
Yeah.
But 20 is an attractive entry point for Nestle. I don't think I've ever seen it below 18. So, you know, if you say there's 10% downside, I mean, that's a you know, worst case scenario. So that's a really good starting point. But the thing is, they're about to start growing earnings because they are still putting price rises through. And next year, raw materials inflation is negative, not positive. So the jaws go the other way. And that's really what we're playing for these companies. And we're actually looking for another, maybe a couple of opportunities within that because they've just been hit really hard and they are good businesses. And now's the time to get in if you can, because you're buying them at a relatively cheap valuation. But the trouble is, you've got so many different areas that are attractive. I mean, we've just been talking about European autos on 2.5 times earnings. And now we're talking about Nestle being, you know, almost all-time low valuations and being able to grow its earnings. And then we've talked about Airbus and the long-term growth opportunity there and Metso. So you just got so many opportunities. And it's really, the hard thing is deciding which ones to allocate capital to.
Yeah, well, I guess you have to have a sort of like a reasonably diversified, high conviction strategy. You can't just go all into one story, which you know, it seems to be the most attractive. You actually do have to be, you know, split your portfolio, I guess, into stuff you're absolutely delighted to own, just to give you that level of sort of like, you know, risk management.
Yeah, I think that's right, isn't it? I mean, I've always tended to run quite high conviction portfolios, so you know, reasonably big positions. They hurt if they go wrong, and they make a big difference if they go the right way up at the top. And then, you know, obviously a bit of a tail where you almost, what I call it, like you're almost paying the blinds. You know, in good terms, you're paying the blinds because you think it's a good opportunity over the medium term, but you're not quite sure if now's the time to go for it, or perhaps there's a timing aspect. So that's where the sort of pragmatism of the approach comes in. I mean, there's contrarianism, which, you know, works over the medium term because you're doing something different from everyone else. But the risk of it is you get caught in a value trap. And that's where pragmatism of having some sort of sense of where we are in terms of their earnings cycle and a bit of a sort of a timing based approach, not on the market. You can't time the market, but individual companies, you can say, well, now is really a good time to get in because it's very unloved and things are turning around, rather than just buying a falling knife, as it were. So that's
you're right. I mean, that's absolutely, it's a really key sort of like investment principle. When I've in this historically, I've fallen into that trap. You sort of like go too heavily.
We all do. I mean, you know.
Go to now another one in the consumer, but in the higher end, we've got LVMH, we've got Swatch, and Luxottica, which does the glasses like Ray-Ban and this sort of. Do you take us through really how you see that sort of more wealthy, affluent consumer? Because Burberry came out, you know, with a profit warning. We've had Diageo also coming out with a profit warning, largely because people weren't holidaying in the Caribbean, and actually there was a bit of demand destruction out in Las Vegas at the Grand Prix because the prices were too high, even for the high rollers. So What's your sort of your view of your longevity on the really sort of well-heeled, affluent consumers?
Yeah, so European luxury is obviously like one of a real strength of Europe. I mean, LVMH, I don't know if I think it's, well, Novo will be Europe's biggest company now, but certainly Bernard Arnault for a minute was the richest man in the world, wasn't he?
Yeah.
So it's a real strength. I mean, the luxury goods story is all about China, like, just to be very clear.
Yeah.
You know, and the narrative goes like this: China's creating 1 million millionaires a year, and all of them are going to buy a handbag. And they're not going to buy a domestic brand handbag. They're all going to buy one from either Mulberry or LVMH or Hermes. Yeah. I think obviously that's really why they're so sensitive to China macro. Yeah, okay. LVMH is a great business. I think the reality is that you're at a relative low point for consumption for China. You know, they haven't really come back post-COVID in terms of travel, which is where you make all the money. You know, in the end, they'll come on a shopping trip to Paris, basically, because there's almost an arbitrage, which is why they're so good at pricing, these companies. Yeah. And as they get more and more data, these companies become brilliant. The best ones, like LVMH, become brilliant at knowing who's buying what, where, when you're allowed to buy something. And there's a really good analyst I used to work with, young guy. I'm sure he'll be watching, and he really opened my eyes to it. He said, what you want to look for luxury goods is good behavior. And what he meant by that was any luxury good company can pump their profits up by 50% over 2 years, because all they do is they supply all the demand for their product. And the lower end companies, maybe Burberry is one of them, are not very good at resisting that temptation. Yeah. The great luxury goods companies, and what makes them true luxury goods companies, and we've mentioned Ferrari. Ferrari is a great example. I don't own it, but it's a great example of this. You can only buy a Ferrari if you're on the list. And you can only get on the list if you've bought a Ferrari. And if you buy the Ferrari and then flip it for a profit, you don't get on the list for the next one. Yeah. And Hermes are masters at that. If you try and go online and buy an Hermes scarf, you can't. If you call up the shop, which I've tried, because I wanted to see if it was true, not because I was buying an Hermes scarf, don't worry. I called up the shop and I said, could I, do you have any in stock? Oh, come down, sir, and we'll have a conversation about it. So they're really good at like holding back supply to create this scarcity value, which is why they trade on high multiples, because of course they could make their profits much higher in the short term, but then they would destroy the long-term value of the franchise. So there's a number of opportunities. So now's the time to have a look at them. Again, it's another area to look at. I mean, we don't own it. I've been looking at Rémy Cointreau. You mentioned Diego. So Rémy dominate cognac. Yeah. And the current earnings of Rémy are almost irrelevant. Yeah. Rémy is like a mine. Okay. It's like a mine that grows. It grows grapes, and they've got 100 years worth of brown liquid in a cellar in cognac that they're very good at blending, putting in a pretty bottle, and shipping it and telling a story and putting it in the right place down the right channel. So that brown liquid, if you imagine it's like a mine of cognac, that brown liquid it's almost like you should be valuing it on a sort of net present value or a NAV basis of that brown liquid. Yeah. Trouble for Rémy is no one knows what that number is, because they disclose it at cost. And of course, the cost of growing those grapes from 100 years ago is entirely irrelevant when it comes to valuing it as of today. Yeah. So you have to try and sort of peer through the gloom, and there's all sorts of clever analysis that you can do to try and get to what that brown liquid is worth. And it's basically trading below the value. So there's no value in Rémy for its future goodwill. I don't own it. We might conclude that now's not the right time, or it's permanently impaired because the cost of cognac was so high, or the drive to Baiju and the drive against corruption and anti-gifting policies in China. So I'm not going to front run my conclusion. Yeah, okay. But these are the sort of opportunities. These are the weird and wonderful ways you have to look at those luxury goods stocks. It's a bit of an art. It's a bit different from your CFA-based analysis of net present value. It just doesn't work like that. Yeah, no, it's your intangible value, which is in the quality and the exclusivity. And I must admit, I would quite fancy being in your position, doing some due diligence on that
on those sellers at Rémy Cointreau.
I have done the site tour, but I wasn't. They demurred when I asked if I could have a taste of the Louis trays. So
Oh, okay. Well,
I think
I'll
it's about 100 grand a bottle. So
okay. Well, you might have to buy a lot of shares before you do get a free,
exactly, I think
free
so.
tipple. Now, just finally, we've got obviously another sector which is sort of positively correlated with the cycle is banks, and we've got UBS who bought. Well, basically saved Credit Suisse in April, I think.
Some would say stole Credit Suisse. But,
okay, well, there's that as well, yeah. And then we've got Swedbank, which I think is the Sweden's equivalent of Lloyd's as well. Do you want to take us through just quickly sort of how you see the banks? Because it is actually an area that people are sort of like, it's been a battleground area.
I think, I've done the job for a while. I was always sort of seen as the only person in Europe that would invest in banks. There's about 3 of us that were overweight.
Yeah.
2016. I've moved to underweight actually recently.
Okay,
I'll talk you through the investment case of those 2 stocks.
Yeah.
But broadly, I'm underweight. I think we're at peak earnings.
Yeah. Okay.
Valuation is very attractive, no doubt about that. But I think, with these very cyclical sectors, unlike a lot of the other cyclical sectors that are going to see a pickup, banks are going to see a rollover as rates start to come down. And they've obviously seen a massive boost from higher rates. So provisioning it's as good as it gets for the banks. Provisioning is very low and has stayed low, even though the economy has slowed down. Rates are at a peak and coming down. Political risk is coming in. I've seen the Spanish guys put a windfall tax on their banks. So it's hard to see where the next sort of catalyst really comes from for the banks. Now with UBS, we were quite lucky. I was doing an interview like this on a TV program on the Monday morning, and unbeknownst to us, the Credit Suisse UBS blew up overnight. So there I was at 11 o'clock on a Sunday night listening to the conference call, and it became very apparent to me that this was a steal. Basically, it was a fantastic deal. UBS didn't really want to do it, although that you might say that's a brilliant negotiating tactic. But for 3 billion of equity, they were able to buy about 52 billion of value through the wipeout of the AT1s, through the guarantees the government gave them. Obviously there's a huge strategic rationale because they've consolidated the Swiss banking market, all that wealth management business, which was, culturally it wasn't great. I mean, it was a bit racy. Well, to say the least, it was very racy the way that Credit Suisse ran it, but they're still going to inherit a huge client base there. So it became apparent to me that this was very cheap. And then, I sort of, by the presenter, got slightly bullied into this massively profitable trade when he said, well, if it's such a good deal, are you going to buy some? Oh, maybe. Anyway, shares were down 10% on the morning. So we took the plunge, and it's been a good call from there. I think it's sort of broadly reflected now. I think that's quite consensual. So I'm not sure I'm banging the table on that anymore, but there was a real opportunity within UBS.
Yeah. Just on that UBS, I did notice, I think whilst you're away, they issued some AT1 bonds.
Unbelievable.
I know, at less than 10%. And I was just thinking, you just wiped a whole bunch of people out on Credit Suisse AT1s, and you've issued some more much cheaper. What? Brilliant.
I couldn't believe it when I saw that. I think what I said at the time, and I stand by it, is they were Swiss AT1s.
Yeah.
And they had a particular Swiss clause in them.
Yes.
Basically said, if there's an equity issue and there's a government support for your bank, even if the equity isn't wiped out, which of course was the controversial thing in Credit Suisse, is that you wiped out the AT bondholders, but you didn't wipe out the equity. And so that clause, basically, I went and read it, and it said it basically said caveat emptor in not so many words, but it not in Latin, in Swiss. But it basically said, well, in English actually, but it basically said if there's government support, there's a high probability, effectively, that the AT1 bondholder will be wiped out. And of course, that's exactly what happened. Now, I don't know. I haven't checked, but I wonder if maybe that clause isn't in these new ones.
No, they're not. They're not. No, it's absolutely treated as equity if it defaults. Yeah, it goes to equity. It's not wiped.
Pari passu. So they've kind of got away with it, but you know.
I know. What about just quickly? What about Swedbank in terms? Because I think it's a mortgage broker, isn't it, or mortgage lender largely in Sweden.
Yeah. So Swedbank's, they've been a bit of a naughty boy. There was an expose on Swedbank around some of the kind of anti-money laundering failings that they had, like most European banks had over time. And they're currently in dispute with the DOJ. The fine will be some billions. I mean, maybe 10 billion kroner, maybe 20. That's in the price. That's broadly reflected. They've cleaned up their act massively since then. So I'm always prepared to, if a company if it's had a problem and it sorts itself out and that's credible, we'll track it, we'll monitor it. But providing that is in place, we're prepared to invest on a kind of from a governance perspective in those companies. As you say, a salient market position, very cheap, big dividend yield, which I like, because unlike some of the other banks, I don't have to wait. The one thing that Swedbank's got in its favour, DOJ aside, but the one thing Swedbank's got in its favour relative to other European banks is the regulators on its side. And the reason for that is that the Swedes had a big banking crisis in the 1990s. And the mantra, and I forget what it is in Sweden, but in Swedish, the mantra is never again. And what they've decided, the way they've done that, and this is the right approach, and it's a shame we didn't take the same approach, is they basically said banking is going to be a utility business. We're going to restrict competition. So actually, we're only going to have a 4-player market, because if we allow a load of small startups, one of them will be really aggressive. They'll take market share. Then everyone else will have to be really aggressive. Lending standards will fall, and we'll have another crisis. And so they sailed through the GFC, and they'll sail through the next crisis. They've got 4 banks. They all make excess profits, and the regulator is very comfortable with that. There's a cost to the consumer of slightly higher mortgages, like 10 basis points higher. I mean, it's not ridiculous. But what it means is that it's an insurance policy. Effectively, the consumer is paying the insurance policy. So the government, which is everybody, in reality, doesn't have to bail them out. And so where other banks have got a lot of political risk, outside this DOJ issue, Swedbank is pretty well placed. And I think, given where valuations are, they're one of the few banks that are going to be able to grow earnings on that basis.
Got you. No, it does definitely sounds as though it's got a secure balance sheet. Now, just before we finish, is there anything that sort of investors should avoid in the sort of doing going forward over the next year? And I'm guessing it's given you're quite positive. It's don't be too cautious or something like that or whatever.
I am, like everybody else, is tempted by gilts at 4.5% when there's a tax break. Because we all pencil in our 7 or 8% from equities, and when we can get effectively more than that in gilts on a gross basis, is very tempting. I would caution against taking that too far, because they don't operate in a vacuum, and the reason they're up there is twofold. Well, the effect is onefold, and there's a reason. The reason is inflation is embedded in this, back and embedded. Not 7-10%, but probably 3-4%. And I think that's probably fairly straightforward piece of analysis people can do. That's why they are where they are. Equities will grow more quickly than the past on the basis that there's nominal growth. If it's 3% inflation and maybe, let's be bearish, 1.5% real GDP growth for the next few years, and then obviously negative recession, that's still pretty good nominal, much higher nominal GDP growth. And people forget that equities they live in a nominal world. These companies have all put their price up because of inflation. They've all grown their earnings. People are surprised that earnings haven't fallen. But the answer is we're in a different environment. So that's the first thing. But the second thing is the reason why, Europe is within 20% of its all-time low, on about 12 times earnings. The reason it's at an all-time low, the reason why mid and small caps are so cheap relative to history, is all because the cost of capital's been higher. And if we think inflation is coming down, and if we think that 4.5% is really attractive and we need to lock it in now, then that's going to have a really positive impact on the environment. So you might be turning around so just think about the reinvestment risk of that. You might make yourself 4.5% investing in the January 2025 zero coupon gilt, but in what you're going to do in January 2025, you might pocket your 4.5%, and then have to go and buy an equity market that's, significantly higher. And so you've lost out. And so that's what I would just say is, don't lose sight of the fact that there's opportunities in lots of asset classes. And if you swing the pendulum too far and you just say, well, that's really attractive, so I'm going to go sell all my equities, or I've got 4% in UK equities, I'm going to zero. I've got 4% in European equities, I'm going to zero. I'm just going to have a bunch of FANGs, or the Magnificent Seven, which is basically what you've got if you've got a global passive fund, because it's a big part of the index. And then, it's a bunch of bonds. Yeah. I think you're going to potentially regret that in a few years. So that's the only thing I would say. I think if you remain invested in equities, if you can look for perhaps, areas of the market that haven't done particularly well over the last 12 months when we've had this kind of economic slowdown, that's where you're going to make outsized returns on a medium-term view. I think there's an outstanding opportunity for wealth creation from here, because people are, not really looking at it, and that's what creates the opportunity.
Brilliant. Okay, well, that's a great place to finish. Very positive note. If people want to invest in the River and Mercantile European Fund, how best to do it, James?
Yeah, so if they're private investors, they can go onto our website and follow the links there and give us a call. We've also, if they've got an IFA or an advisor, they should speak to one of our fantastic salespeople here. We call them salespeople, but they're sort of consultants, hopefully, a consultative relationship, and ask them to get in touch, and we'd be more than happy to help if we can.
Brilliant. Okay, well, thanks very much for your time. Brilliant insights into investing in all things European equities, and very much look forward in catching up in 2024.
All right, fantastic. Thank you very much, Paul. Good to be here.